to order. Today's hearing, again, is in a hybrid format. Our witnesses in person. Thank you. How does the Fed, Mr. Chair, evaluate the economic uncertainty caused by Putin's actions? What steps do you take to mitigate those risks, like inflation?
The ultimate effects on the U.S. economy of the war, of the sanctions, and of events yet to come is highly uncertain. And so we need to be alert to what those might be. I think what we know so far is that commodity prices have moved up significantly, energy prices in particular. That's going to work its way through our U.S. economy. We're going to see upward pressure on inflation, at least for a while. We don't know how long that will be sustained for. In addition, we could see risk sentiment declining, risk-taking sentiment declining. So you could see lower investment. You could see people holding back on spending. Those people, the biggest risk to being able. This is a great labor market for workers, particularly workers in the lower quartile of earning, who are getting the biggest wage increases and really very, very high wage increases. So the problem really that we're facing is one of high inflation. And over time, those people, the biggest risk to being able to sustain a long expansion and have continued increases in participation, for example, which has tended to lag declines in unemployment, is to sustain or really restore price stability. Economic staff in one building, and that's where all the governors were. So the ruble weakened dramatically through this, which is the Russian currency, and what those sanctions do is make it very difficult for the central bank of Russia to do its job, which is to support the ruble on behalf of the government. And it's because the sort of resources that it had to support the ruble were tied up in a way that made it difficult for them to do that. That's part of it.
In its supervisory capacity?
No, I do not.
Do you expect that the strains on the oil or energy markets that we will see coming out of this war will act to push inflation even higher, or will act as an impediment to our ability to get inflation under control?
In the near term, and we already see this, oil prices are up, substantially from where they were 2 months, 3 months ago, and that will get into gasoline prices and other fuel prices, and that will show up in higher inflation. The question really is, what will be the extent of those, and even more important, what will be their persistence? Demand and supply are in sync.
Thank you. Mr.
My question is, have you looked at what $125 a barrel looks like, $150 a barrel, even $175 a barrel, what that might mean in terms of growth and inflation?
For every $10, and the thing that matters more than anything is how long does it persist for? Mm-hmm. You can have an oil spike, mm-hmm. and if it just comes and goes, prices will go up, but it won't actually affect ongoing inflation. That's really the key thing. But I think I want to say $10 of oil, and I hope I don't get this wrong, is like 2/10, something like that of
inflation.
Of inflation.
Yeah, say $125 or $150 a barrel.
Well, it would.
And a lot of it was draconian. You have to do it. Is the leadership at the Fed under you and the Fed prepared to do what it takes to get inflation under control and protect price stability?
Well, let me say I knew Paul Volcker. I'm pretty sure I saw him testify in this room many years ago. I think he was one of the great public servants of the era, the greatest economic public servant of the era. And I hope history will record that the answer to your question is yes.
So you're prepared to do what it takes without any reservation to protect price stability?
Yes.
That would be a departure of what you've done. Thank you very much.